Okay, folks, one word. Violence. We have three things to cover today. Number one, we need to talk about what happened in today's market, including, yes, Ooga Booga AMC and squeeze stocks. Number two, I want to talk about what I see as a good deal right now. And number three, I want to talk about one thing that's quite frankly shocking. And I do think it's going to be an unpopular opinion, but hear me out before you disagree with me. And before we get into it, the only thing that I ask of you in return is that you hit that ravishing like button, and also don't forget to subscribe either. Okay, so to start, market was certainly more risk off today. Most indices fairly flat and down. In terms of squeezers, BBIG showed some directional strength today, with a nice SMA bounce going from 618-ish to the 8s in the after hours. You look at some of the recent data for BBIG, and borrow fees are going through the roof, making it harder to short than ever. And of course, more risky to short than ever. And for bullish activity, Benzinga reported today in regards to the options trading that around lows this morning, traders purchased over 3.33 million in bull call contracts, betting on heavily bullish moves. Rapid sweep orders that happen to be close to lows. What does that suggest? Well, it suggests some institutional players getting a little bit bully McBully on this. It seems like, quite frankly, there's a strong presence in a lot of these squeeze stocks of institutional money trying to help further these trends because they think they can make quick money off squeezing some of their competitors. They know that BBIG will eventually come down and short sellers will be right in the long run, but they also know it doesn't even matter. Because if BBIG goes up enough, short sellers are going to be out and gone on the streets before that can even happen. We certainly don't yet have the data that suggests where these sweep orders are coming from, but minimum, even if some of this was actually from short sellers hedging their bets, it's still arguing that, hey, they think they're more wrong now than they did when they first took the position. Now, we had some folks asking me to discuss the potential with the company itself and its partnership with some guy named Ted Farnsworth, his role in the company and his potential to grow the company. My thought process, quite frankly, is I don't care. This isn't a fundamental play based on the company's value. And to be quite honest with you, Ted Farnsworth was the guy from MoviePass. It was his idea. That didn't go over so well. You're allowed to be wrong, but I mean, I don't want to make a bullish argument based on this guy's track record, especially considering this isn't a company that's proven itself to be anything except for a short squeeze candidate. I love the fact that it's an NFT play. I love the fact that shorts are getting crazy greedy with this play. And I love the idea that there's a combination of retail traders and institutional traders trying to call the short sellers' bluff on this. Short sellers can run, but they can't hide. Wait, they can hide. They can hide very well, actually. But you turn up that heater enough and they start coming out in a sweat. Now, do I think that it makes sense to buy and hold these types of plays? Honestly, no. Take Friday's run, it ran from the 3s to $10, but then it got cut nearly in half again to $5.51 this morning, and then it had a second run. Sure, you could have just held it from the drop from 10 back down to 5 and then held it again back to 8, but you still would have lost a little bit of money. You would have missed out on the second run potential. You wouldn't have given yourself the opportunity to lock in profits in the $10 region. My take is, why not play the moves separately? I totally understand that there's a retail movement based around a lot of these stocks, and I don't mean to step on anyone's toes, but at the same time, this is the stock market, and you do have to account for yourself and ask what type of risk you're willing to take on for what reward. Xcella woke up again today with its second attempt at a breakout, pushing a few pennies higher than it did Friday and Monday's pre-market. High short interest combined with a lot of the cooling off in many of the other meme stocks right now suggests that if we do start seeing some more risk on trading, well, Xcella may end up actually being one of the first in line to benefit from that. Okay, SPRT had a down day today. Do I think it's going to have more rebound rallies? Yes. Do I think it makes sense to buy and hold and wait for it? No. Wait until it shows some proof of concept. I love the saying proof and not promises. Make it prove to you that it has the momentum to get back to a new high. We started briefing on this one at $8. It had a cycle up to $59 and it had some residual runs back and forth in the following days. This was a fine and dandy play so far, and we're happy with it. If you want to play it again, why risk it for the biscuit when you can just wait for some proof of concept first? There's certainly a lot to suggest that we are due for a rebound reversal if it does reverse quite a bit to the downside. We discussed the entire situation with the merger and failures to deliver in yesterday's video, and you can go check that out for a better breakdown. But SPRT is one that I'm closely tracking. I just don't think it makes sense to buy and hold. I think you should trade the moves themselves without letting the moves trade you, so to speak. Okay, AMC, another green day for the Ooga Boogas. A lot of the sell attacks that forced AMC down from that breakout to $48 last week haven't been anywhere to be found this week. Oh, sell attack, where art thou, sell attack. We've seen some small attempts at a downward reversal, but they've largely been just whiplashed away. But if you see AMC get enough momentum to break past that previous 48 to 49 resistance and then push it into the 50s, it could certainly suggest that we're actually getting closer to upgrading to a higher price channel. AMC has a strong history of being controlled within a channel where it bounces from say 30 to 40 over and over again, and then the goal is to get the channel to stair step down. But the less that sell attacks are able to keep it on the higher parameter, the more that it breaks above that parameter, the more that they have to use a higher channel in order to control it. But you look at the bigger picture and you see a very intriguing story in terms of momentum. We've actually been in a fairly bullish trend since the beginning of Augusto, which is August for those who don't speak foreign languages. Pushed slowly and steadily from 28 and gained steam to today's high. And I would expect if that trend continues to see more and more capital emboldened to accelerate it. Short sellers right now know that, hey, the sell attacks that they did on the previous rally didn't really work, and you're already starting to see a new attempt at a breakout. It looks like they're thinking, hey, let's let it run to the next level, and then we'll do another sell attack when it starts taking a breath. At least that's what I would do if I was a short seller. They've been ineffective at controlling this at these prices, so let it run a little bit higher. It's not going to be a disaster. And then when you get to that price point, that's when you start destroying a lot of those bulls. That being said, at the same time, I mean, there's a lot more stubborn money in this now, whether it's institutional or retail is more emboldened than ever. There's a lot of stubborn money, and you start seeing this trend over a month, and it's like, hey, this is heating up. Okay, moving on, let's talk ChargePoint. So tomorrow, ChargePoint will be reporting their earnings, but quite simply, there's not much they can say that's going to change my conviction on the company. EV trend is clear. Adoption is going up month over month. They build charging stations. We need charging stations. There's a massive amount of people on the roads with EVs, and there's a massive under-equipping of charging stations in this country. It's also true that it's trading within $1 or so of multiple quarter support at around 19-20 bucks, which puts it at a historically good deal. That being said, I know this has been one of my more disagreed upon plays because of its performance this quarter, but keep in mind my price target on this one has stayed $40 despite the uptrend that got very close to that price target in May from that May rebound, and despite the massive sell-off, they got it back down to the 20s, which is half of my price target. The reason is because I see ChargePoint as very, very difficult to argue with. The value is very, very clear. And the reason it's down is also pretty clear. When you look at a high conviction play, you have to ask yourself, is the performance this quarter based on the company itself being shite? Or is it based on the market not being in a cycle to reward EV stocks right now? I would argue that the EV sector as a whole is one of the few sectors out there that you can see the future fairly clearly. We can forecast on space technology and exploration and virtual reality industries as much as we want. But the EV industry is showing proof of concept in the here and now. And guess what they need? They need some charging. I don't think a few quarters of supply chain shortages and fear-based trading is going to change that. Do we know when inflows are going to start favoring EVs and affiliates again? Well, I would project clearer policy from the Fed, getting farther along this chip shortage, and finally passing the infrastructure bill that would throw tons of money the way of charging infrastructure providers. I would argue that all three of those things would charge up ChargePoint stock and we'd see a nice reversal. Okay, now it's time for the unpopular opinion. Let me take some tea. Right now, one of the freakiest sectors in the stock market is the Chinese sector. It usually is pretty freaky, but right now it's especially freaky. To me, the sell-offs in a lot of mainstream Chinese stocks is shocking and a huge opportunity. Famed money manager Ray Dalio, who has made a ton of his fortune by buying and exploiting Chinese market stocks over the last 4 decades, made the comparison that U.S. investors almost always over-panic and overreact to every single piece of regulatory crackdown. And that because the average fund manager doesn't actually have boots on the ground and isn't actually analyzing policy objectives over there, that they tend to just sell everything without asking questions. But that by simply looking at history, you can see that regulatory fear and flexing is simply cyclical and almost always ends in huge runs afterwards. But because of the widespread and deep discounts that we're seeing in a lot of mainstream Chinese stocks right now, I actually think this is one of the best opportunities. Specifically, if you're focusing on buying mainstream, Western audited, and internationally exposed stocks. I'm talking about companies that are reporting huge numbers, making more money than ever, and have a huge power grasp on the economy. And today I just want to give you one stock, for example, Alibaba. One of the biggest players hit by the Chinese regulatory crackdown, massive sell-off. Big winner last year, big loser this year. You can love and hate it, but the average analyst price target is projecting 60% growth. And history suggests that it's had a ton of cyclical sell-offs and regulatory problems that were short-lived and always bounced back. Chinese currency crisis in 2015 and 2016, that basically cut BABA stock price in half from $115 to $59 before it went and rebounded. Another round of regulatory crackdowns in 2018 that took it from 208 to 132, and now of course we have the current wave of crackdowns. If history is to repeat itself, the period of time that's best to buy it is during peak fear and not during peak momentum and euphoria. So what's the bad? Well, the bad is there's certainly some justified fear here, and that justified fear could be around for a few more months, maybe into 2022. But the good, well, there's a lot of margin for error with these valuations. Look at how much the company has grown since the last time it has been at this valuation, and it's clear that this is at record cheap prices for what you get. Last time it was trading here was mid-2019. At that time, BABA was reporting 675 million active users. Since then, it's consistently grown active users quarter over quarter to the last report at 828 million. You look at quarterly revenue. Halfway through 2019, we were sitting with a $16 billion revenue report. Now we are sitting at $31 billion. Gross profit-wise, on a trailing 12-month basis, we've consistently seen more and more strength. $27 billion mid-2019, $48 billion today. And quite frankly, Alibaba has always been a stock that during its euphoria periods trades very, very high multiple. In fact, the first time it traded at this level that it's at today was in 2017, where the metrics were much, much more humble. The company also boasts a very, very healthy cash on hand position and has a lot of international exposure. Now, I'm not saying that BABA is a fast money play or that there aren't continued risks involved. And while these prices are a pretty good damn deal, I also wouldn't blame you for wanting some more proof of concept in terms of BABA showing a little bit more strength before you start buying in. But I think that when you look at history, this too shall pass and the euphoria will come back again. And I think that over the long run, buying during a lot of peak fear scenarios is one of the best ways to hedge yourself against overvalued positions elsewhere. If that involves 3 or 4 high conviction Chinese stocks that have sold off rapidly, hey, so be it. Anyways, folks, that caps off the video. What do you think about this issue? Let me know below. If you'd like to learn how to trade with our step-by-step lessons, our private chat, and of course, our daily morning briefings where we brief on all the latest catalysts that we see each and every market open morning, well, I'll go ahead and put the link to ZipTrader you below. FUDSTOPPER50 will get you $50 off before checkout. You just put the coupon code in the add coupon spot and you are golden. And if you're wondering what broker to trade these stocks on and you're looking for a day trade to short-term trading broker, my suggestion is you try out Webull. Webull will also give you 2 free stocks if you sign up and deposit just $5 with our link below. Now, if you're looking for a longer term broker and you're more of a buy and hold trader, hey, public.com is another great option, and I'll put a link to them below as well. Anyways, folks, that caps off the video, and I'll see you in the next one.